Hey everyone, the Social Security Administration doesn't treat every person the same way. Based on the year you came into this world, your full retirement age differs, the options available to you differ, and the errors that can permanently shrink your monthly payment differ as well. And at this very moment in 2026, there are individuals in each of these categories who are either getting paid less than they actually qualify for or are on the verge of making a choice they will never be able to reverse, simply because no one ever took the time to walk them through what the rules genuinely say for their particular circumstances. That's exactly what I'm going to do today. Locate your category, pay attention to what's relevant to you, and when this video is over, you'll know precisely what to review and what steps to take. Before we dive into the categories, if you haven't subscribed to this channel yet, please go ahead and do that right now and make sure you hit the notification bell. Here's the real reason that actually matters. The regulations surrounding Social Security are constantly shifting, claiming ages, income thresholds, Medicare costs, repayment guidelines, and whenever those things shift, the SSA doesn't reach out to give you a personal breakdown. They update the rules and assume you're already up to speed. What I do here on this channel is take those updates, break them down in terms of what they genuinely mean for your individual situation, and deliver that information to you before deadlines slip by and before costly errors are locked in. Every group I'm walking through today has something specific unfolding in 2026 that affects them in a real and direct way. The people who are subscribed to this channel learn about these developments while there's still time to act. Those who aren't subscribed tend to find out after the fact, after the wrong claiming choice, after the window closed, after the money has already slipped away. Go ahead and subscribe, hit the bell, and let's get into it. Group 1, born between 1943 and 1954. You are somewhere between 72 and 83 years of age. You've been receiving Social Security for some time now. Your full retirement age was 66, and at this stage, the majority of people in this group tend to think there's nothing left to examine or review. That way of thinking is actively costing some of you real dollars every single month. The first area people in this group should examine is whether they're actually collecting the correct benefit. A meaningful number of widows and widowers within this age range are drawing on their own retirement record when they would actually receive more money by switching to their late spouse's record, or the opposite situation applies. The survivor benefit available to a widow or widower can equal up to 100% of what the deceased spouse was receiving at the time of death, and in certain situations that figure is substantially greater than what the surviving spouse collects from their own record. If you've lost a spouse and never specifically asked the SSA to compare both benefit amounts and move you to whichever one is higher, there's a genuine possibility you've been leaving money uncollected for years. Reach out to SSA at 1-800-772-1213 and request that they pull both figures and compare them side by side. The second matter for this group has to do with Medicare, specifically the IRMAA surcharge. If your income happened to be elevated in prior years because of a property sale, a Roth conversion, or any type of one-time financial event, Medicare may still be billing you at a higher rate based on that outdated income information. IRMAA surcharges range from roughly an extra $70 all the way up to nearly $500 on top of your standard Part B premium every single month. The appeal form is called the SSA 44, and it was created specifically for individuals whose income has gone down because of a qualifying life event. If you're currently paying more than $185 per month for Medicare Part B, it's worth taking the time to find out why. Group 2, born between 1955 and 1959. You are somewhere between 67 and 71 years old. And this is the most important group to address in 2026 because the rules are genuinely different for every individual birth year within this range, and the vast majority of people are unaware of their own specific number. Here is the complete full retirement age breakdown for this group. If you were born in 1955, Your full retirement age is 66 years and 2 months. Born in 1956, it's 66 years and 4 months. Born in 1957, it's 66 years and 6 months. Born in 1958, it's 66 years and 8 months. Born in 1959, it's 66 years and 10 months. That is your number, not simply 66, not simply 67, but your precise month and year. Why does this carry so much weight right now? Because people in this group are in the process of making their claiming decision or have just recently made it. And the gap between getting it right and getting it wrong is something you can never go back and fix. If you claimed at age 62 with a full retirement age of 66 and 6 months, meaning you were born in 1957, your benefit was cut by approximately 25.8%, and it remains at that reduced level for the remainder of your life. On a monthly benefit of $2,000, that comes out to $516 less every single month. Spread across 20 years, that adds up to $123,000. The SSA does not issue a warning before you claim. They simply process the paperwork. For individuals in this group who have not yet filed, if you've already passed your full retirement age and still haven't submitted a claim, each additional month you hold off earns you 0.2% more permanently. That accumulates to roughly 8% per year. Between your full retirement age and age 70, you can build up anywhere from 24 to 32% more per month for the rest of your life, depending on your exact birth year. On a $2,000 benefit, that translates to potentially $640 more every single month indefinitely. And for those in this group who are currently employed and collecting Social Security before reaching full retirement age, the earnings test is something you need to be aware of. In 2026, if your earned income exceeds $23,400 in a given year, the SSA will withhold $1 for every $2 you earn above that threshold. The withheld amount isn't permanently lost. It gets added back to your record once you hit full retirement age. But if you're unaware of how this rule works, that withheld portion can feel like your payment simply vanished without any explanation. Group 3, born between 1960 and 1965. You are somewhere between 61 and 66 years old. For every single person in this group, full retirement age lands exactly at 67, and right now, the most critical thing for people in this group to fully grasp is what happens to their benefit if they choose to claim before that age. Filing at 62 with a full retirement age of 67 cuts your monthly benefit by 30%. Permanently. On a $2,000 monthly payment, that means $600 less every single month for as long as you live. Stretched across a 20-year retirement, that represents $144,000 in total losses compared to simply waiting until age 67. The SSA will go ahead and process that early application without alerting you to these consequences. They'll ask whether you understand that your benefit will be reduced. You'll say yes, and that reduced figure becomes your permanent amount. There is also a claiming option that most people in this group have never heard about. If you file after reaching your full retirement age of 67, you can request as many as 6 months of retroactive payments. The SSA pays you as though you had filed up to 6 months earlier than you actually did. On a $2,000 monthly benefit, that amounts to a lump sum of up to $12,000 delivered along with your first payment. The trade-off is a slightly lower ongoing monthly payment going forward since your effective start date shifts back. The option is real, and almost no one ever thinks to ask about it. For individuals in this group who are still 5 or 6 years out from filing, the single most valuable thing you can do at this point is verify your earnings record. Head over to ssa.gov, create a My Social Security account if you haven't already, and pull up your Social Security statement. Go through the earnings listed for every single year and compare them to your own personal records. 1 year that's recorded incorrectly, an employer who submitted the wrong payroll figure back in 1995, a year of freelance work that never got logged, a job at a company that shut down and whose records never got transferred can reduce your monthly benefit by approximately $100. Find the problem now while you still have enough time to get it corrected, rather than stumbling across it after you've already submitted your claim. Group 4, born in 1966 or later, you are 60 years old or younger, you are nowhere near the point of claiming Social Security. And that is precisely why what I'm about to share with you is so important, because the window to resolve certain issues before they actually cost you anything is still wide open, and it will not remain open indefinitely. Your full retirement age is 67. Claiming at 62 results in a 30% permanent reduction. Waiting until age 70 means potentially 24% more than your full benefit permanently. Those figures are already locked in. What has not been locked in yet is whether your earnings record is accurate. The Social Security Administration has been logging your payroll information since the very first job you ever had. That data was submitted by your employers, and with every single year that passed, there was an opportunity for something to go sideways. A wrong number submitted, a year that got skipped over, a period of self-employment that didn't get recorded properly. Every mistake that doesn't get corrected will reduce your eventual monthly payment by approximately $100 for each year that's missing or inaccurate. If you were employed through the 1980s and 1990s, back when payroll processing was done manually, there is a genuine possibility your record contains at least 1 year that doesn't accurately reflect your actual earnings. Fixing it is not complicated, but it does require documentation, and documentation becomes increasingly difficult to track down the longer you let time pass. W-2 forms, old pay stubs, prior tax returns. These materials are far easier to locate right now than they will be 15 or 20 years from now. Go to SSA.gov, pull up your Social Security statement, and go through the earnings listed for each year against whatever records you currently have access to. If something doesn't line up, file a request for correction of your earnings record and include your supporting documents. The SSA will review and process the correction, and your record will be updated accordingly. Handle it now while you still have the paperwork available, and while making the fix won't cost you a single dollar. So here is the breakdown by group. If you were born between 1943 and 1954, find out whether you're drawing from the right benefit record, particularly if you're a widow or widower, and investigate whether you're being overcharged on Medicare through an IRMAA surcharge, because you may have solid grounds for an appeal. If you were born between 1955 and 1959, nail down your exact full retirement age right down to the specific month. Fully understand the permanent financial consequences of claiming ahead of schedule. And if you're still working while collecting before your full retirement age, make sure you understand exactly how the earnings test functions. If you were born between 1960 and 1965, truly grasp what a 30% permanent reduction looks like in concrete dollar terms before you make any decisions about filing. And look into whether the retroactive lump sum option might apply to your specific situation. And if you were born in 1966 or later, log on to SSA.gov today and go through your Social Security statement line by line to verify your earnings record for every year while you still have the opportunity to fix any errors at no cost. Subscribe to this channel and share this video with someone in your life who falls into one of these groups.